So it seems that every indicator says that the US economy and the global economy is already growing at faster than expected rates. However, is there a concern or should we be afraid that that same economic growth that seems so favorable could actually overheat and cause something damaging like inflation, which could harm investors? What should we be doing or thinking about that? We're going to talk about that in a little bit. My name is Kent Kramer, and this is Financial Perspectives. I'm the Chief Investment Officer at Foster Group, and we're going to look at some things for the 2-week period ended March 19th. So for the first time on February 12th, over 2 million vaccinations were given in the US in one day. Since March 4th, the US had been averaging well over 2 million doses per day. That's the kind of speeding up that makes economic activity seem like it's going to be a sure thing. Everybody's happy about that. It's hard to imagine that just over 12 months ago, COVID-19 seemed a small mystery, virtually no US deaths, no vaccines even contemplated. Now, a little over 12 months later, we are close to having 20% of the adults in the United States vaccinated, and globally, vaccination is picking up as well. Israel leading the way with over 50% of their adult population already having been vaccinated. All this has led economists surveyed by the Wall Street Journal to raise their average forecast for 2021 economic growth, raising it from 4.87% in the February survey to 5.95% in the March survey. Last week, the Fed raised its 2021 GDP forecast to grow more than 6.5% in 2021, with inflation coming in at 2.4%. That would be the fastest growth in 4 decades. Compare this to 2020's 3.5% economic contraction, and you can see why people are concerned maybe about the economy overheating in terms of speeding up. Now, driving this economic optimism is the faster than expected recovery in some areas that were most hurt by the COVID slowdowns, travel and leisure. Dining, for example, the chart on the left, a public activity is really starting to come back. You can see spending on dining is growing. However, it is kind of regionally dependent. And if you look at that chart on the left, you'll notice the brown line, which represents Washington, D.C. of all places, is seeing the slowest recovery in dining. I'll leave it to you to understand if maybe people in DC don't like eating together. On a year-over-year basis, though, if you look at the chart on the right, you'll see Airbnb and VRBO are seeing credit card bookings go way up. So early 21 has seen lots of people beginning to think about travel plans and where they're going to go. Again, that sign of the economy loosening up and people beginning to spend. Now, driving the predicted expansion will likely be consumer spending. There is quite a bit of cash already stored up by Americans, close to $4 trillion in personal savings. You can see that this number rose dramatically in early 2020 with the CARES Act, with direct distributions to families, and it dropped off as people spent it, came back a little bit at the end of the year. Now, this $4 trillion is before the recently passed $1.9 trillion American Rescue Plan, which is going to put billions and billions more in the individual personal savings account, setting the stage for what could be a big spending spree. Some economists are predicting, wait for it, an unprecedented amount of consumption. One more unprecedented event in 12 months, already full of them. This near-term spurt in consumption is one reason the Fed and others expect inflation to rise as high as 2.4% in 2021 before settling down to a longer-term rate of around 2%. Now, I don't know how many of you took a course in economics in high school or college, but my first college economics professor, Professor Albrecht, he made it really interesting for me. Now, I know not everyone's felt the same way, so I'm going to go through just a brief review of supply and demand and inflation. The green curves on the chart represent demand at different price levels. Now, with $4 trillion of personal savings and growing, coupled with the pent-up demand to do things we haven't been able to do for 12 months, like travel, eat out, go to concerts, and more, that kind of sets the stage for a rapid increase in spending, a rapid increase in demand. That's the green curve shifting from D1 to D2, the increase in demand. Now, what happens when that demand, when that spending goes up? Well, that's shown on the P1 to P2. Prices tend to rise. What's going on here is demand rises, more money is chasing fewer goods. The cost of those goods that the money is chasing naturally rises, all other things being equal. But hey, is inflation inherently a bad thing? In a healthy, growing economy, a little inflation is actually to be expected. It's a sign of growth. The Fed would like to see long-term inflation somewhere around 2%. So how much inflation should we expect in the next few years? And as investors, how should we be preparing for it? Well, in terms of what to expect, here's what the bond market, all the investors buying and selling government bonds are indicating for inflation. Last week or a couple weeks ago, Matt Mockelstead, in the same financial perspectives, he mentioned something called the TIPS break-even rate. And that's what we're looking at in this chart. You can see the TIPS Treasury break-even rate is currently about 2.3%. What that means is bond investors are expecting inflation at 2.3%. And what tells us that information is the difference between the 10-year nominal Treasury, which gives a rate of return that doesn't adjust for inflation, and the 10-year Treasury Inflation Protected Security, or TIP, which does give an inflation-adjusted return. The difference between those two yields is the break-even inflation needed to make those two investments equal. So all other things being equal, an investor is kind of indifferent as to whether they buy the 10-year nominal Treasury or the 10-year TIP if inflation is actually 2.3%. At the end of 10 years, those investors would have received the same return. Therefore, the TIPS break-even rate. So expected inflation over the next 10 years, about 2.3%, which is maybe just a little bit higher than what the Federal Reserve is expecting, but not out of range in terms of that 2% they'd like to see. So what should investors be doing? Well, as always, investors should be focused on our real return, our investment growth above the rate of inflation. Investors who are saving or investing today, they need to have the dollars they're saving and investing at least hold and hopefully increase their purchasing power over time. Now, arguably one of the worst periods of inflation in U.S. history was the 1970s and 80s. From April 1979 to March 1980, inflation was 14.76%. Over the 10-year period, inflation averaged 8.62%. That's hard to imagine today. Now, if we look at this chart, you'll see that U.S. small companies over those 10 years were up an annualized 12.42%. Again, providing a positive real rate of return. International stocks were up over 10.6%, also a positive rate of real return compared to that 8.62. U.S. large companies rose only 6.5% during that 10-year period, so they slightly had a negative real return, even though they had a positive nominal return. They lost a little bit of ground. And one-month Treasury bills rose 7.78% versus that 8.62. But imagine getting almost 8% on cash deposits today. I don't think anybody's checking account is yielding that right now. Fast forward another 10 years and look at the entire 20-year period ending in December of 1991. All stock market investments succeeded in providing significant real rates of return, even with the high inflation of the 1970s and 1980s. And U.S. one-month Treasury bills, cash basically, they kind of held on to their purchasing power, either increasing or decreasing relative to inflation. Historically, stocks have been among the best sources of real return outstripping the rate of inflation for long-term investors. Cash or short-term high-quality bonds like one-month Treasuries have been relatively good and inexpensive inflation hedges, meaning they tend to track or keep pace with short-term inflation, but they're not going to provide long-term higher real rates of return. One reason that these bonds track or hedge inflation is that the Federal Reserve uses short-term interest rates to fight inflation. And when inflation rises too much, as it can when the economy overheats, the Fed raises short-term rates to try to slow down spending. When short-term rates go up, borrowing rates, the rate of money at which banks lend it out, they go up as well. It's more expensive for people to borrow. When it's more expensive for people to borrow or companies to borrow, we tend to spend less, shifting that demand curve back to the left, or at least slowing down its shift to the right, which causes prices hopefully to stabilize. That's been the history of monetary policy, and it's what happens normally when we experience inflation or deflation. In terms of getting real return in the last 12 months, well, we've had an incredible recovery. The global stock market investors have just been amply rewarded for staying the course, if you will. And that's right. If you look at this chart, the orange return, that's U.S. small company stocks are up almost 130% since March 18th, with other stock markets up significantly between 60 and 75% as well. Those are very, very strong real rates of return in anybody's book. Now, we have to remember that in the 4 to 6 weeks prior to March 18th, those same markets were down 30 to 40%. It just shows the importance of having long-term discipline when pursuing long-term higher real rates of return. So what are the takeaways for investors as a result of what we talked about today? Well, one is certainly vaccinations and personal savings are ready to push GDP up towards that 6.5% rate of growth that the Federal Reserve is predicting. So if that happens, we should certainly expect some demand-driven inflation. There will be more dollars chasing fewer goods, which will cause some prices to rise a little bit. We also want to remember that if we get a little overly concerned about inflation, we need to remember to focus on those real rates of return, and global stocks have been excellent sources of real rates of return for disciplined long-term investors. We also want to remember that cash may actually hedge some short-term inflation risk in terms of having those short-term rates move up or down as the Fed moves rates to try to moderate inflation if it were to happen. But those same cash investments are likely not going to create real rates of return that we all need for our investments if we're going to make significant progress as we save for the future. Last point I just bring up again is disciplined investors have really been rewarded with remarkable recovery and dramatic real rates of return over the past 12 months. We continue to think that long-term diversified portfolios that include stocks and bonds based on your financial plan is really the best way to go and ensures you the highest probability of success. I close with a humorous quote from Will Rogers. Invest in inflation, he said, it's the only thing going up. The good thing about this quote is it's funny. The other good thing about this quote is it's not true. There's lots of other things that go up besides inflation. We've just looked at how global stocks tend to provide strong real rates of return for investors over time. So it's fun to laugh with Will, but it's also important to remember what we are as investors. We're long-term participants in markets that tend to provide us with strong real rates of return, the things we need for secure financial futures. Hey, as always, if you have any questions or would like to meet with a Foster Group advisor, please contact us. Our team is fully engaged every day. We can have a technological meeting face-to-face over the internet, or we can get together in person. We're taking more and more of those kind of meetings all the time. Also, if you have particular questions that you would like us to address in these Financial Perspectives videos, we'd love to hear from you, because we'd like to be addressing the questions that are closest or most important to you. You can, again, send those questions to us at any of the contact information on the slide. Thanks for joining us today. We look forward to seeing you again in a couple weeks.